Hello everybody. Firstly, I'd just like to welcome you to this webinar where we'll be talking about the top-level US and Chinese trade war talks and look at how might they affect gold, the dollar, crude oil and other instruments. My name is Sasha and I'm a financial analyst from the research department at Fortrade. If you have any questions, please call us and ask to speak to a senior account manager who'll be happy to help. Before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure you know that although gains can be made trading CFDs, losses can be incurred too, and you need to be aware of this. Now, first off, we'd like to introduce you to what we call a market opportunity. A market opportunity is a one-page briefing containing market analysis, and our goal is to provide you with a simple-to-understand opportunity to trade on the markets. We will select an instrument such as gold or a currency pair and tell you our very best estimate on its price direction so that you can trade on it if you want to. Market opportunities are produced by the research department on a daily basis according to market conditions and based on historical evidence. This can relate to daily trading, weekly trading, or monthly trading. A market opportunity consists of fundamental analysis, geopolitical events, and technical analysis that includes a pivot point and support and resistance levels. It's important to understand that it's solely your decision whether you trade on market opportunities or not. Here's an example of a market opportunity. Here you can see some fundamental analysis on what's going on with the euro-dollar currency pair. You can see that this is a downtrend opportunity over a weekly period, since our analysis suggests the euro would decline in value against the dollar. At the top, you can see some geopolitical events and fundamental analysis that can influence the euro-dollar currency pair. For example, the part on the situation in Italy, which has affected the euro. When using a market opportunity, it's vital to look at the pivot point on which the calculations are based. In this instance, if the price reaches 1.1381 that you can see on the left-hand side of the screen here, this shows the right moment in our estimation for opening a trading position. That's how you decide to trade on this opportunity when it was active. You can see below the trend direction and the time period. It's also important that you know how to use the stop loss and take profit options. You have support and resistance levels further down. At these points you can put a stop loss and take profit, and on the right hand side of the screen you have calculations. If you close the position using take profit, you can expect these kinds of profits at these support levels in green. If the price is going against you, you can potentially have a loss of this amount at these resistance levels in red. Finally, profit and loss calculations are based on a one-lot trading volume. So the trade war and talks between the US and China have dragged on for many months now, with both sides struggling to agree on key issues and imposing tariffs upon one another. Mid-level talks ended recently, and this week top-level talks are beginning. But let's take a quick look at how we came to this damaging trade war. President Trump was elected on a platform of America First, and one of his campaign promises was to reverse what he saw was the unfair trading position of the US against its partners. For years, China has been accused of benefiting from the current trading conditions, stealing US intellectual property, and taking American jobs. Since Trump's election, the world's two largest economies, the US and China, have been locked in an escalating trade battle. In 2017, the US launched an investigation into Chinese trade policies and has steadily imposed tariffs on Chinese products from 2018. So far, the US has imposed 3 rounds of tariffs on Chinese goods, totaling more than $250 billion. China has responded by saying the US has launched the largest trade war in history and used its own tariffs against the US worth $110 billion. So how has the trade war impacted the markets? Not positively. Generally speaking, the answer to this question is negatively. Whilst it's true that stocks are close to record highs, they would very likely be higher without the trade war. A report published by Bloomberg from Renaissance Macro Research earlier this year showed that the S&P 500 was 11% lower than it otherwise would have been. Whatever the exact figure, we can be reasonably sure that stocks would be higher. This isn't just because of the jitters that investors get on a daily basis which affects stocks. It's because company fundamentals, that's earnings and revenue, are negatively affected by a trade war. Gold and the Japanese yen are so-called safe haven instruments that investors and traders tend to buy in times of geopolitical or economic uncertainty or use during a recession. This has also been the case during the US-China trade war. I'll return to this in a moment. Overall, the dollar has been supported by the trade conflict with China. The reason is that in a trade war, investors believe that the US is best suited to survive the economic impact. But most recently, since evidence emerged that the US economy may be slowing down, the dollar has not grown on trade war fears. Why? Well, a slowdown in the US economy makes it more likely that the Fed will cut interest rates, and investors know that lower rates tends to make the dollar fall in value. So what's the current situation? Mid-level trade talks were held in September, which were described as constructive by US officials. And some weeks ago, it was confirmed that top-level talks would continue on October the 10th in Washington. This will be the 13th round of high-level negotiations, and the talks should go on Thursday, October the 10th, and Friday, October the 11th. Investors and ordinary people probably will be hoping that the talks will extend. The South China Morning Post, seen as an influential publication briefed by senior sources in the Chinese government, reported last week that both China and the US have good reason to reach an interim trade deal. The Chinese appear to believe that impeachment proceedings against President Trump make it more urgent that he has a policy success to point to before next year's US election. At the same time, since US economic data points to a slowing US economy, it will be increasingly in the US interest to end the trade war. Until now, poor economic data coming out of China had the US thinking it held all the cards, meaning that they could take a firm stand against Beijing. It's interesting that the article mentions an interim deal, since President Trump recently rejected the idea of an interim deal. But this is before the impeachment inquiry and a glut of poor economic data, which has sent US stocks spiraling over increased fears of an eventual recession. At the beginning of the trade war, the US dollar tended to go up when trade tensions increased, due to the sense that the US economy was strong enough to weather any storm, at least above other global economies. This belief among investors is starting to change, due to some poor economic US data. At the same time, a slowing US economy has caused and will continue to cause the Fed to lower interest rates, which tends to lead to a weaker dollar. For that reason, we will examine gold and crude oil more closely as the primary trading opportunities for these negotiations. Crude oil is affected by multiple factors, but the primary one is the global economy and the trade war. A growing economy supports crude oil since it implies that demand for crude will remain high. If the economy slows or the trade war pushes the global economy into a recession, demand will collapse and there will be too much oil in the market and crude prices will fall. Let's take a look at crude prices over the past year and see where they might head in the near future in the event of successful or unsuccessful talks. Of course, crude is affected by multiple factors, but we are looking at prices relating to the economic slowdown and to trade war. Over the past year, crude oil has fallen some 28%, although crude is up by 15% since the beginning of the year. Crude oil declined almost 6% last week, with much of the decline due to slowing US economy. Investors fear that if the US economy continues to slow, the country could end up in recession. A slowing US economy or recession would certainly mean a collapse in demand for crude oil, causing lower crude oil prices. This is why trade talks are so important for crude traders. An agreement would support crude, whilst a continued trade war would likely mean less demand for crude. As far as gold is concerned, things have looked good for the commodity in recent months. The precious metal was flying at 7-year highs, while trade and other geopolitical tensions plus falling interest rates made gold a very sensible option. We can see a very different story from the past year on this gold chart compared to the crude oil chart that we saw previously. Gold has jumped higher, making gold bugs very happy with their investment over the past year. The precious metal has jumped 27% since the beginning of the year. It's climbed 17.8% and saw a fresh record high in September. Gold has mainly been driven by three factors: the trade war, geopolitical risks, and lower Fed interest rates, which has pushed gold prices higher. Over the past week, poor economic data in the US and the EU has pushed prices back towards 7-year highs. To simplify, successful trade war talks will be good for higher crude prices and stocks, and might put downward pressure on gold prices. If the talks fail, this would support gold prices but would place downward pressure on crude oil prices. In this scenario, we would also expect stocks to go down in value. It's also important to bear in mind that since the poor economic data releases in the US, the trade war will have even more impact on the markets and investors' decisions. But remember, the trade war is only one of the most important factors that move prices, but it's not the only one. So you should also base your decisions on other developments in the markets. Well, I hope you found this webinar useful. Of course, at ForTrade we will be following developments related to the trade war and the instruments that we mentioned in the webinar. Please get in touch with your senior account manager for further information. Until next time, goodbye, and please join us at ForTrade again soon.